Today we're going to talk about non-resident sellers in the state of Rhode Island. So Rhode Island state law mandates that you be a resident of the state of Rhode Island at the time of sale. So what that actually means is that if you are not a Rhode Island resident, you want to listen more because you are going to have to pay a non-resident tax as a result of this. Generally speaking, residency or domicile is established by a few things. Where is your driver's license issued? Where do you register to vote? Where do you pay your income taxes? So you can only have one domicile. If you are a Rhode Island resident, then at the time of closing, you will sign an affidavit attesting to the fact that you're a Rhode Island resident. You'll present us with a driver's license and the conversation is over. If you are not a Rhode Island resident, however, that is when you are going to need to consider an advanced filing of the non-resident withholding tax with the Rhode Island Division of Taxation. This filing is going to identify your gain on the sale. So we're going to be taking into consideration the sales price, all of your transaction costs and expenses of the sale, including your commissions, your attorney's fees, and miscellaneous closing costs. Additionally, we are going to reduce it by your cost basis. So if you know what your cost basis is, great. If not, it is a term of art. It's used by accountants, so your accountant should be able to get you this information. Otherwise, a cost basis is generally going to be determined by taking your initial acquisition price, what you paid for the property, adding to it all of your capital improvements, and taking out any kinds of depreciation that you've made over the time you've owned the property. So your net sales price or your net gain is going to be what you actually pay taxes on, and that is going to be the determination for the non-resident withholding tax. If you have to pay non-resident withholding tax to the state of Rhode Island, generally speaking, you may also be faced with capital gains on a federal level. These, though, are not due at the time of closing and will require federal withholdings and something that you can file with your accountant at a later date. Some exemptions that will be available to you if you are a non-resident, such that you might be able to avoid the non-resident tax, is if you use this property as a primary residence. So that's when we're talking about you lived there for 2 out of the past 5 years, you haven't sold any other primary residence in the past 2 years, haven't used any portion of the property for rental purposes. To that end, you may be able to exclude all or part of that gain that you otherwise be taxable to. If it's not taxed on a federal level, generally speaking, it cannot be taxed on a state level.